Assalamu alaikum warahmatullahi wabarakatuh. Let me introduce myself. My name is Salma Alisha Sahdiya NPM 23412046 Accounting Class 23A. Course Market and Financial Institutions. Here I will explain about bank credit. Let's listen to my explanation. Understanding bank credit. Bank credit is a loan facility provided by a bank to its customers with certain conditions. This credit is usually given in the form of money that must be returned by the debtor, borrower, within a certain period of time along with the agreed interest. Types of bank credit. Bank credit is divided into several types based on the purpose, term, and collateral provided, including based on purpose. 1. Consumer credit, used for personal needs, such as vehicle credit, home ownership credit, KPR, and credit cards. 2. Productive credit, used for business activities, such as working capital and investment, based on term. 1. Short-term credit, usually has a term of less than 1 year, such as working capital credit. 2. Medium-term credit, has a term of between 1 and 5 years, for example for the purchase of operational equipment or vehicles. 3. Long-term credit, has a term of more than 5 years, usually for KPR or long-term investment credit, based on collateral. 1. Unsecured credit, KTA credit that does not require physical collateral. 2. Collateralized credit, multi-purpose credit that requires collateral in the form of assets such as a house, vehicle, or land. Benefits of bank credit. 1. For individuals, enables people to meet urgent needs or consumptive needs without having to wait for money to accumulate. 2. For companies, helping companies obtain capital for business expansion, purchasing raw materials, or financing other investment projects. Bank credit requirements. The general requirements that are usually required for credit applications include: 1. Photocopy of KTP. 2. NPWP. 3. Pay slip, for employees, or financial report, for self-employed. 4. Business certificate, if the application is for a business. 5. Savings account for the last few months. Credit application process. 1. Credit application. Customers submit a credit application by filling out a form and completing documents such as KTP, NPWP, proof of income, and other letters. 2. Credit analysis. The bank conducts an analysis to assess the customer's ability and eligibility to pay the loan, which includes analysis of character, capacity, capital, economic conditions, and collateral. 5c. 3. Credit decision-making. After the analysis is complete, the bank will make a decision whether the credit is approved or rejected. 4. Contract signing. If approved, the customer will sign a credit agreement that includes the loan amount, tenor, interest rate, and collateral. 5. Credit disbursement. Credit funds are disbursed to the customer's account or directly to a third party according to the agreement. Credit interest rate. Fixed rate, interest that remains the same over a certain period. Floating rate, interest that follows interest rate movements in the market. Debtor's risks and responsibilities. The credit recipient or debtor has the responsibility to return the loan along with interest according to the agreement. If the debtor fails to pay off the credit, the bank can collect or take collateral if the credit is secured. Therefore, prospective debtors need to carefully consider their ability before taking credit. That's all I can say about bank credit. Walaikum salam warahmatullahi wabarakatuh.